Software stocks lagged artificial intelligence names by a significant margin for most of last year, and that performance gap has persisted even as the AI trade has cooled. But how do these stocks look when it comes to fundamentals? Does AI really represent an existential threat to their businesses? Here's Morningstar senior equity research analyst Dan Romanoff on what investors need to know. Thanks for being here, Dan.
Thanks for having me.
We're here to talk about software stocks, which have kind of trailed the rest of the tech sector for the better part of a year now as AI has taken off. Can you walk us through why that happened?
Yeah, it was really astounding. I think starting in July of 2025, so sort of right before 2Q earnings, software was more or less in line-ish with sort of the broader, the Morningstar US equity index. And from that point on, software diverged meaningfully, and that the market continued to tread higher overall, and software just fell off a cliff. And it has been a bloodbath. And I think the reasons for that are a lot of fears around AI. And so, sort of in order, at first, I think it was AI is going to obviate the need for software in general. And I don't think that is true at all, but I think that was the initial fear. And then it became, well, AI is going to pressure the need for as many software seat licenses. And so, this whole SaaS model that we have now is just going to generally be pressured. Okay, that's at least debatable. And then it became, well, no one's really paying for AI right now. No one's generating enough revenue. And so how is software going to profit from this? And it's early days. And so that I think that's the answer to that one. And then, sort of the last fear is like who's generating any revenue at all. And so there's like two ends of the, like people are having a tug of war with themselves. Like no revenue is being generated. And by the way, this is going to take over the software industry. And so it's just fear, 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 and there's a lot of uncertainty, and there's no way to prove that it's not happening. There's no way to dispel the fear, and so therefore investors are just going to invest on the fear and worry about it later. So I think that's what's happening.
It feels kind of sentiment driven.
Yeah, that's if I was a better analyst, I would have just said
No.
it's sentiment driven.
No, you laid it out perfectly. But on the other side of the sentiment coin is, the fundamentals of the stock, the cash flow, the revenue, our quarterly performance. How does that look in software right now? Are you still feeling confident about it?
Yeah, it's crazy. So like I keep this spreadsheet, and I track this exactly. And so every quarter I have a new tab in my file, and so for 3Q, which was reported in October, it was basically I covered 20 companies. That was 20 beats across the board. Everyone beat.
Wow.
And that's in revenue and profitability or EPS, depending on sort of the way they report. So just good results overall. And then from a guidance perspective, the guidance was more or less in line or a little better. And that's a general characterization. So, sort of true. So that's the environment. And by the way, that was all of 2025. There was no period where you were like, oh, results are coming in terrible.
Wow.
It was basically all beats and kind of raises. And that was all of 2025. And so that's the environment we're in currently. I kind of think that 2026 will be more of the same. Results will be pretty good on average. And in that environment, software stocks are selling off aggressively. And so the fundamentals haven't changed much, but certainly the sentiment and the stock performance has diverged pretty wildly from the actual fundamental performance.
That's so wild to watch. I'm thinking of the chart of our AI index or an AI index and a software index, and the lines are diverging kind of further and further as the weeks go on.
I got to say, I help David Sekera with his quarterly market outlook, and in doing it for the most recent quarter, so I think I submitted that in December at some point, and technology was still one of the best performing sectors from a stock perspective, including how bad software was, and so hardware and semiconductors are obviously going gangbusters, while software was like an albatross around the whole thing, and still the sector performed pretty well. So pretty amazing run for the AI trade, the
Absolutely.
AI side of the trade here.
Yeah. So it feels like what investors are kind of responding to and trading on is this kind of existential threat that they perceive to software stocks from AI. And there's a lot that you mentioned a little bit at the beginning about kind of what's in the mix of that. I'm thinking about kind of maybe this pressure that software stocks have to integrate AI into their businesses, to be on the cutting edge, to have the new technology on offer for customers. I'm wondering what that looks like for them in terms of, AI is a much more expensive proposition to scale than a software offering is as we know it right now. I'm thinking about margins. I'm thinking about license sales. You know, how how big is that threat? How real is it? What does it look like?
So every headline in technology, probably in general, is basically AI something, right? And so
Hmm.
semiconductors have one part of that, software has another. If I add up all of the revenue my companies, excluding Microsoft, generate, it's a little under $100 billion. And a few quarters ago, if I add up all the AI revenue they were disclosing, it was about $1 billion. So about 1%. And today it's probably about 1.5% of revenue is coming from AI related sales.
Very little.
Very, very
Okay.
little. And if you ask Microsoft a few quarters ago, they were already saying we're generating more than $10 billion in revenue annually from AI. And so the divergence there is pretty massive. And, Amazon was saying billions of dollars, Google was saying billions of dollars. And so all of that revenue is being generated on like a cloud computing basis. And so basically just outsourced compute, all the NVIDIA GPUs in those data centers are being rented out. And so they have revenue streams. From a software perspective, there's not a lot of revenue being generated in the industry. And it's early days. And every one of these companies, Salesforce just reported a month ago, they said $500 million now in ARR, which is, we'll just use as a proxy for revenue. And they said it's growing at over 300%. So the growth is massive. The revenue dollars are actually pretty minuscule. And, in a quarter or so, the total will probably be 2% of revenues. And maybe in a couple of years, it'll be 5% of revenues. And so that's kind of what we're dealing with. And so it is expensive for sure, but most companies, when I talk to them, those management teams say it's actually the margins are more attractive than the
Interesting.
rest of our business.
Why is that?
Um, well, I mean, they're charging a premium for a premium service.
I
So,
see.
usually they will say you have to have whatever seat license, whatever level of license you need from like a SaaS basis. And then from there, you can buy this like higher tier, which will include the AI offering.
Oh, okay.
And so, but there's also to like more to the heart of your question, there is this like emerging model in software where companies are going to charge for AI like consumption rather than just like a seat license in the SaaS model. And so there's a lot of uncertainty around like what impact that will have on margins and sort of profitability. And I think that largely companies probably are indifferent, quite honestly.
Indifferent.
Yeah, because if I'm Salesforce, say, and I'm selling a seat for whatever Service Cloud, and it costs whatever it does, hundreds of dollars per month. Do I really care if I'm Salesforce if I don't sell that seat anymore and I sell an AI instance that is doing the same thing?
Mm,
So as long as I charge the appropriate amount, the revenues should be approximately neutral.
I see.
And so that pricing model, though, that consumption pricing model is kind of new. And no one really knows exactly how much you have to charge, like on a per token basis or a per conversation basis. And so there is uncertainty around that. But the early returns are it's probably going to be margin accretive, and certainly margins generally have been expanding, and so it's not uniformly for all my companies, but by and large, margins have been going up, even as all these AI sort of products have been being developed and now they're being sold and used to a limited extent. And so margins generally are still going up. And so I think the fear is immediately not real, but
Mm,
this is evolving for sure. And so, maybe there will be some pressure on margins, but I think that's a key debate.
a
And
key if.
yeah, I'm not seeing it right now though. So that's
Okay.
the big takeaway.
Makes sense. And so when you look at the companies you cover, we've talked about the fear, we've talked about the big maybe, and we've talked about the good fundamentals and the huge slide in stock prices, which to in my head I'm going, is it cheap now? Like, are they on sale? Are software stocks good buys for investors? And
So
what are your top
yeah,
ones? What are your top picks?
I would say that if we were having this conversation in mid-July, right before like the divergence in performance started happening, I was saying at the time, software stocks are loosely fairly valued, and so
Okay.
there's value here and there, and there's definitely pockets of overvalued, and so on average, you're fairly valued. Today, no, it's undervalued for sure versus our fair value estimates. There's loosely 25% upside, I think, across my coverage. At Morningstar, we cover, I think, about 80 software companies globally. And so, by and large, I think that the sector is attractive, or the industry is attractive beyond my software companies. And my top picks, I would say, are probably Microsoft and ServiceNow right now. And so I'm going to just say upfront that I just don't believe in the fears. And so I
Mm,
look at it and I say, this is all attractive. If I'm Warren Buffett, I say, look at Microsoft's free cash flow margin and ServiceNow's free cash flow margin of 35%, and say that is a winning formula, for basically low multiples and, the divergence of our fair value from where the stock's trading now. It's just intrinsically undervalued. And so that is a very good value investor time to come and buy stuff. Obviously, we could be wrong on that stuff, but I would say, in some of my names, like to force my DCF model to sort of
when you
spit.
say DCF for our
Oh,
listeners.
right. So instead of using multiples, just say, our stock's worth 20 times earnings. At Morningstar, we use a DCF model, a discounted cash flow model. And so I'm building out 10 years of forecasts for revenues and different expense items and ultimately for profitability. And so that discounted cash flow sort of creates the fair value estimate for, on a per share basis. And so for some of my companies, in order to get to the market price today, you basically have to cut your revenues in half and like take out 1,000 basis points of margin.
I see.
And
For
there's,
them to hit a
yeah,
price as low as
yeah,
they're trading right now.
yeah,
Okay.
and so that's just not realistic. There just aren't precedents for like Microsoft margins going down by 1,000 basis points for no obvious catalyst. And so top picks, yeah, Microsoft and ServiceNow. Microsoft is well positioned in AI. They're one of the three leaders in public cloud computing. They have monopolies in Windows and like the Office suite. They have a near monopoly in gaming. They're just a leader in pretty much everything they do. And they're a leader in AI. And AI is basically generating all the revenues from public cloud. And so Microsoft sort of wins on all of those fronts. And then ServiceNow I would say, is a top pick because they're probably the best growth story in like large cap enterprise software. They were early to disclose what their AI related revenues were. And so they were kind of seen as a leader from the get go in AI.
Okay.
That's growing very rapidly for them. They've been far more profitable than some of their other large cap peers, famously better margins than Salesforce, even though ServiceNow is like a quarter of the size of Salesforce. And there just aren't many companies that can operate at a 20% growth in an environment where software is sort of growing at 12%. And so and they're big now too. It's more than $10 billion in revenue, and they're still growing well above the industry median. So
Yeah. And cheap? Are they undervalued too?
they're undervalued
Okay.
too. And
Cool.
and they just made a couple of acquisitions like a month ago. And so like investors were kind of poo-pooing those. And I definitely understand the sentiment, but like you already had an attractive asset that is sold off further. And I can say maybe those change the story and, they're the biggest acquisition ever, but it's still an $8 billion acquisition versus a $150 billion market cap. And so it's still immaterial, really. And I don't think it changes the growth trajectory at all. Would I prefer they didn't do it from a purity standpoint? Yeah,
Mm.
sure. But, over the long term, I think it'll be additive to growth and, it'll be a good product within the portfolio strategically. So those are my top picks.
Great. Well, two to watch. I think, and thank you for walking us through this. I think this is one of the most kind of interesting stories in the market right now. I don't know. It's been fascinating to watch. So glad to have your take.
Sure, no problem. It's great to join you.